Hey, thank you everyone for sticking around for this next conversation. And I think this one is incredibly timely. Fed rates are on the move. Inflation has come down but hasn't quite gone away. Trump geopolitics are in play worldwide. And then, of course, there's the technology cycle, which we've been talking about a lot today, especially around AI, which is also moving really fast right now. So we have the perfect group on stage. In fact, I would go as far as to say it's like getting the old band back together from last year as well to talk about where to allocate in 2026 with a combined 750 billion US dollars under management on stage in front of you. So let's dive straight in. Anne Walsh from Guggenheim Partners, overseeing some 350 billion in assets. His Excellency Waleed Al-Muhairi from Mubadala, 330 billion in assets under management. And Tony Manella from Eldridge, 70 billion in assets under management. So happy our team is back to talk about what's happening in the year ahead. Your Excellency, with that in mind, I'd like to open it up with you. Perhaps make some opening remarks for us. And in so doing, what is Mubadala's macro base case for 2026, and where are you seeing the most compelling global opportunities right now?
Well, first, thank you so much for having me back on this year. It's great to see so many familiar faces in the audience, and of course, it's an honor and a privilege to be sitting next to the panelists I always speak with, which I think is great. I think from our perspective, number one, we can't start other than by welcoming everybody to Abu Dhabi. It's the season where we are able to convene, whether it's through Milken, through the races, or through Abu Dhabi Finance Week. Forget 750 billion in assets, trillions upon trillions of assets, as Abu Dhabi really kind of turns into the capital of capital. So as we think about what 2025 looked like, I was telling some members of my investment committee, I said, I sure wished that the year ended about 3 weeks ago. Not that there's anything wrong with where we are today, but I think that brings me to my first kind of point in terms of 25 and very likely 26, and that is volatility is very unlikely to go away, and that's not a very hard statement to disagree with. I think at the end of the day we are entering kind of this period over the next 12, 24, goodness knows how long it's going to be, set of time where I think two things are going to distinguish the winners from the folks that only do okay. I think number one is how you manage volatility through building resilient portfolios. And I'm happy to speak about that if that's interesting. And then second, and here's where we're spending a lot of time, is figuring out where we can discern signal from noise. Okay, so the more signal to noise, and the reason why that's important, investing has never been straightforward, right? But I think it's getting harder because you have many discontinuities that I think most members of our audience are very clear about. We're navigating a huge technological shift through artificial intelligence, right? And so a question, is this going to turn into a huge boost in productivity? So I happen to think so, but you've got folks all over the spectrum from an opinion perspective. You've got folks already talking about what's going to happen with a potentially overextended private credit set of portfolios. I happen to think they're probably going to be fine, by the way. But again, you have a lot of folks who are saying, hey, look, things might get a little shaky. And private equity still hasn't resolved its DPI problem. So you're seeing a lot of different things that are coming together, again, that really just point me in one direction, which is how do we stick to our guns of being thematic investors, number one, and in so doing, hopefully discern what that right signal is in the increasingly noisy environment that we are seeing, and then ultimately give our shareholder, in this case the government of Abu Dhabi, the return that they're expecting of us.
Fascinating, and the perfect setup for the conversation, raising a lot of interesting points there. And this is something that you and I also discussed earlier today, tracking the signal, not the noise. What's your macro base case for 2026, and how are you thinking about where we're at in this rate cycle, particularly the conversation around the Fed right now, given the normalization underway and also the uncertainty over who is ultimately going to be leading that institution in the coming months?
Certainly. Again, thank you so much for having me today, and I am in violent agreement with Waleed. So many points. But let me add a few about what's going on. It's interesting with all this backdrop, all this really big picture, long trend change that's happening, whether it's technology, infrastructure, globalization, or in this case, maybe more deglobalization, and multipolar world that we are in. What seems to have emerged, at least as regards the rate cycle in the US in particular, is a trading range. Weirdly enough, what we've seen is the 10-year in the US has really traded between 3.5 and 5. And once the Fed last year started cutting rates, it really kind of took the top off that range. So you're talking about mid-3s to mid-4s. And we're entering the third, fourth year now of, we're through the third year and into the fourth year of this trading range. So that at least within the world of volatility and significant change is kind of an anchoring point. But it's interesting as we watch the rate cycle evolve and the Fed, regardless of who gets that nod, ultimately, if it's Fed chair coming in, we're looking at a relatively dovish Fed. No matter what they like to say in the narrative that they're using, they're really pretty dovish. Let's look at where we are. They've ended quantitative tightening, and in fact are probably going to start buying back onto the balance sheet. That's a stimulative action. And they're certainly going to continue to cut rates. We happen to believe that neutral in the U.S. on Fed funds is 3%. So that means they have room to cut a few more times, and we do believe that they'll cut here this month as well, and probably at least 2 times based on the employment story in the U.S. Why is all this happening? Well, actually what we're seeing is this sort of an equilibrium state in the U.S. in terms of growth. So trend growth in the U.S. over the long term is about 2% real GDP. Our prediction for this year and next is sort of right around 2%. Maybe it's a little lower, but it's not a recession. And if that's our base case, then that seems like it's a pretty easy opportunity for the Fed to move towards a neutral stance. Not a stimulative stance, but a neutral stance in response to what is emerging as more of an equilibrium U.S. economy. And that is in the backdrop of a fairly equilibrium global economy. So it's sort of a steady state, at least until about mid-2026 in our view, albeit, I agree, with some real volatility, because the headlines are going to continue and we have to continue to navigate in uncertain waters.
Tony, weigh in here as well. What's your macro base case for 2026, and what is the thing that investors are perhaps not talking about in this rate cycle?
Well, first, fantastic to be here and honored to be up on stage with Ann and Waleed and you, Dan. So thanks for having me back. I think certainly, as Ann mentioned, rates are going lower. I think the question is, as the Fed lowers interest rates, what do corporations do? Historically, you've looked to hire. It's been a stimulative for employment. Given what Waleed's talking about with artificial intelligence and how we're using it as an organization, I don't think you're going to see a knee-jerk reaction of companies to actually just in mass go out and hire. I would rather spend an incremental dollar of capital available to Eldridge on compute, on technology. We have one person that's just dedicated to focusing on artificial intelligence and how do we use it. And the only way to use it is really to throw yourself into it. And if you throw yourself into it, then you can identify opportunities where you can save time. You can get to an answer quicker. Ann and I were joking, backstage that, gone are the days that junior analysts are going to have to, read through 10Ks and 10Qs in order to, analyze a company or even, probably build spreadsheets in the very near future. And so you got to take a step back and you got to, really, analyze and use information and become a better investor, really by leveraging, that technology.
And just given the backdrop, you're comfortable taking risk in credit and equities in this environment, at least through the first half of next year, Tony?
I mean, what are you going to do, right? You can't not. I mean, I think we're looking to deploy capital. We have a cost of funds. We got to, thoughtfully be able to deploy it. I think right now, the way we look at the world at Eldridge, you've got a risk-free rate of about a little north of 5%. So it's unacceptable to earn anything less than, call it 5.25 right now. And you can get that through AAA CLO liabilities, which have never defaulted, which are about 128, 130 basis point spread to SOFR. On the other end of the risk spectrum, you have, equity opportunities that we're looking at that are, into the 20s. It takes underwriting. Now, what's the risk to go from 5.25% to 20%? That's our job, to be able to analyze that and be able to put ourselves in a position that it's more likely than not that we're able to achieve the yield that we're underwriting to.
And reasonable to expect public equity market correction, particularly at the top end, on this innovation trade in the coming weeks and months, though.
I don't see a major. I mean, I think there's been stocks that have run up. I mean, Google's doubled over the course of the past 6 months or so, for good reason, right? And I think there's going to be winners and losers in the whole race for capex and spend. We've been big investors in some of the data center financings and the GPU financings. I think unlike previous cycles on fiber optic build out and the internet build out, you have some of the biggest market cap companies in the world that are behind this data spend, and so I think you can rest assured that the financing, absent a bet on GPU recoveries and what the residual values are there, I think the financing structures that have been put in place and investment grade financings are good, solid ways to earn high single-digit rates of return.
And I'll get you to react to that as well. What's the public equity market correction risk right now?
Well, so I'm in agreement. I like to think of where we are. The valuations appear stretched at the macro level, but I would say it's bubbly, but not a bubble. I contrast very significantly where we are today to where the dot-com era bubble was, for the reasons that Tony has already cited. But I agree also, when you're looking at these markets, they're very unequal. In the U.S., there's the Mag 7, and then there's the 493 other members of the S&P 500. And the performance of these at various parts of the equity market have diverged quite considerably, which tells us that not all parts of the equity market are actually contributing to or benefiting from the use of technology, and I would say yet. So we have a long way to go. And I also think that when you look at the Mag 7 and or the very largest tech companies, they're conglomerates today of technology. And so, when you think about back to the dot-com era, and we were looking at those companies, they didn't even have real earnings. And we saw very, very significant multiples on basically air. And I don't think that's the story right now. We actually have fundamentals that work for these kinds of investments at this particular time. But I'm going to underline something, Tony, that you said, and that is when you're underwriting to data centers, and I think there's a lot of concern at the headline level that we're over-investing, particularly at a debt level, leverage level within data centers, the residual value is really important. And to think about how you get repaid as a credit investor over that period of investable time, and that you get return of principal, and you don't leave yourself a large amount of residual value against which you're lending. Because I think that is, obsolescence risk is real in this particular storyline.
Before we move on from that as well, I do want to ask about what's happening in AI, but Your Excellency, maybe weigh in on this as well. What's your take on the innovation trade right now? And you mentioned earlier perhaps some concerns, some fractures in private credit. What concerns you the most at the moment?
So starting with AI. So personal opinion, I think we're at the very beginning of another kind of technology super cycle. Okay. It doesn't mean that it's always going to be up and to the right. So there could be some volatility, there could be some pullbacks, as we've seen, and the winners of today may not be the winners of tomorrow. But I do feel that we're kind of at an inexorable time at the moment, where a mix of corporations, governments, and ordinary men and women are just using something that is making their lives so productive. Okay, so forget PE multiples, forget the public markets for a moment. Maybe just kind of a human type of story that tells you something. So for those of you that either live here or have spent any amount of time here and you pull out your smartphone, we have an app here called TEM. Okay, TEM is our government services app. Okay, and I see that there's some folks in the audience that have interacted with it. And what's incredible about this app is it has more than 1,500 government services on it already. You can talk to it in a dozen languages. And I'm not advocating that this is necessarily the best thing in the world to do, but you do not have to interact with another human, okay, when you want to put an addition to your house, which obviously used to be a very painful process, right? Uploading documents, doing all that stuff, getting your driver's license, having an addition to your family, change in status, paying fines. You're at a point now where, all the way from young kids to senior citizens, 75, 80, 90-year-old folks are sitting here talking on their phone to this government app. And they're saying, well, what's my pension calculation? Or how come I didn't get this payment in? Or I want to, build a little addition to my house, or whatever it might be. And so when you see that being pervasive in a society, something's changing, right? And you can't help but think, even though it may not be fully clear to you, that there are going to be productivity increases that are going to come as a result of that. And if that's true, then we are in a time of great change and hopefully growth that will come as a result of it. As Mubadala, our AI journey is just beginning, but we've already seen kind of three waves in that journey. The first is the easy stuff, the low-hanging fruit that I think everybody has been looking at. How do you use AI to help with things like, hiring people, recruiting, interviewing, legal document preparation, kind of the back office corporate side of stuff. And that's been great. The second phase is we developed something where we actually have an investment committee member that sits alongside us that opines on all the different things that we do. And if I was going to characterize it right now, I would say that it's about the same level as kind of an early stage associate, which is great. It's only going to get better as we feed it more data and as we interact with it, and so on and so on and so forth. And then ultimately, I don't think we have the tools yet to do this, but the ultimate goal for us as an institution is how will it enable us to be better investors? And remember, we're generally private market investors. And that's a harder nut to crack. So if you are in the public markets, there's so much data, it's easier to apply artificial intelligence to it, and then either pick or look at momentum or trends or whatever it might be. In the private markets, it's a little more difficult, but we're working with our partners to figuring out how we can do something that will be impactful. And so that's at an institutional level. And then once you build out and start looking at, well, how do you enable AI build-outs around the world? As you know, we've created something called MGX in partnership with many like-minded investors. And here it's about infrastructure. And how do we enable, through the provision of energy and all the different parts of AI build-outs, how do we enable that capability around the world? Right here at home, in the United States, and in other parts of the world. So from my side, when I think about AI, I'm very optimistic. Again, it doesn't mean I know what direction it's going to take. It doesn't mean we necessarily are able to translate who the winners and the losers are. But we do know that, like the internet, this is something that's really going to revolutionize the way that we live. And therefore, it's going to have a pretty big impact on the world.
MGX also an investor in OpenAI. Is that still a good bet?
So you're gonna have to ask them. They made the deployment. But I tell you, I use ChatGPT all the time. If that's any indicator of anything.
And just to pick up again, also to follow up on private credit, anything that concerns you right now?
Look, again, private credit, like many other asset classes, goes through a cycle, right? And so unclear where we are kind of in the cycle as it is right now. We're not seeing massive upticks from a default perspective in our portfolio yet. But again, as a through-the-cycle investor, we've had 4 fantastic years in private credit, and so we know that that's likely to perform cyclically. So I don't think that it's going to implode in a shape, way, or form. I don't see anything structurally, as long as, again, you diversify well, you build the right type of resilient portfolio. It's about construction right now and managing risk, as opposed to saying, well, this asset class is either going to perform well or not perform well.
Okay, let's go back to AI just for a second as well. Speaking of managing risk, so I mentioned on stage earlier with His Excellency, the AI Minister, about how Ray Dalio is now talking about how parts of this are looking very much like a bubble. He said that calling it a bubble now looks like calling the internet a bubble in 1995, which I thought was really interesting. But what would you say are the areas that look most challenged right now as we move into the deeper part of this cycle? And are you concerned about the sustainability of the financing behind some of these large-scale AI build-outs? Your Excellency, I'll start with you because, of course, the UAE is building Stargate here, of course, backed with US technology partners as well, following the US NVIDIA chip approval. I think this is a big deal, right? This is 5 gigawatts right here in the UAE. Can you finance it? If so, how? And what's most worrying about the level of spend that we're seeing right now in this space?
Look, it's undeniable that there's going to be winners and losers, right? There's no question about it. So how do you ensure that you are in the former category and not in the latter? For us, it's about partnership and it's about managing risk. Okay, and so again, as long as you are very deliberate about who you work with, and again manage risk, and not everybody is able to take the same type of risk. Right? So ultimately what works in an equation like this is once you are crystal clear about your risk appetite, you structure around it and you take the type of risk that you need. I would venture to say that we are very bullish on artificial intelligence. We think that we have picked kind of the right segment within that, and with the partners that we have and our approach, our thoughtful sort of methodical approach to investing in that space, I think we're going to do just fine.
What does this NVIDIA chip deal unlock for Mubadala?
For Mubadala, nothing. So Mubadala is not a party to that. I think what's great for the country is having cutting-edge compute is great for the country, given, listen to what I just said earlier about all the different applications that we are using from an AI perspective in this country. So having that kind of compute is only going to be better and better.
Okay, let's expand the conversation a little further here. Tony, over to you on this as well, because you have a really interesting vantage point. Eldridge touching everything from private credit to media to sports to tech. When you think about AI, what is it going to mean for the entertainment space and the investability of that sector?
Yeah, I think, so we own an A24, which is the leading independent film and TV distribution and production company in the world. They're heavily investing in artificial intelligence and technology. They've hired a gentleman, Scott Belsky, who's chief product officer from Adobe. He's come in and is really embracing all new technologies, and they, like us, are experimenting. They're trying to bring tools to filmmakers and to creators and to actors and actresses that make movies faster, better, cheaper, in a more efficient way. And I think it's going to be revolutionary. And there's films that that they were looking at, call it 36 months ago, that might have cost $100 million to be able to produce, that they think they might be able to, leveraging those technologies, produce at 10 cents on the dollar relative to what it would have cost 36 months ago.
And do you want to pick up on anything you've heard in the last few minutes before we switch topics?
I would just say, from a data center financing perspective, I mean, there's on-balance sheet financing, and then there's off-balance sheet financing. I think, there was a Blue Owl did a deal for Meta, and a big, data center financing that had a fully amortizing 6.85% coupon on it over 15 years. With a full triple net lease from Meta. That was 165 basis points wide of where Meta, debt was trading at the time. It's the first time I've ever seen an investment grade bond break, up 10 points. So it's certainly it's meta financing, but it's meta financing plus that's coming at a spread premium to where their corporates are. And so the financing for the data center and the AI build is there. Is there going to be capex that's misappropriated? Are there going to be mistakes that are made? Of course. But is society and are we going to be able to make a lot of progress over the course of the next 5 years? And then just from a credit perspective, every single investment that we're looking at right now, we're asking ourselves the questions at the maturity of that loan, whether it's 5 years, 7 years, 8 years, the world's going to look a lot different, and technology is going to have rippling effects, through every single industry. And there's big companies that are, going to cease to exist, and there's SaaS software companies that, are in a trade-off of multiples of annualized recurring revenue, that are going to be significantly disrupted by, AI agents. And so we're all going to get a lot more efficient in our jobs, and you just got to make sure that you're leveraging technology. And historically, I would do that by buying a new iPod at the time, which was a revolutionary product. And when you went from an MP3 player that had 13 songs on it to 1,000 songs, that was mind-blowing. I should have just bought the Apple stock at that point in time. I bought a Tesla early on. I should have bought the Tesla stock at that point in time too. And so sometimes you just got to look at products, look at companies, look at their vision, and throw analysis necessarily out the window and really know that the vision and the product roadmap for that company is compelling and it's going to make an impact on the world.
Anne, did you want to weigh in as well?
Sure, and I think I'm going to use the term of art again, super cycle. And I think that where we are in the super cycle is we're really early stages. I am also an optimist about where technology is going to take us, but it will not get there in an even path directly up and to the right either. And one area that we don't tend to think about is what prevents us from making use of the technology, and why it is that 493 other companies in the S&P 500 haven't yet really developed their use cases in the same way to take advantage of it. And I can't wait for our government in the U.S. to get the app that Waleed's talking about, because, oh my gosh, anybody who has to deal with a DMV in the U.S. knows that it is very, it is stuck in an old world, as it's so many of the governmental functions. But the opportunity set for broad-based use is definitely there. And I tend to concur. We have to rethink valuation in that environment relative to the way we used to think of valuations as purely a PE model. And we have to rethink what is the transformation that's happening. And it's across all sorts of sectors. If we think about what happened in the early 80s for 30 years was a sort of a desktop revolution, if you will. And it touched but didn't impact as much all sorts of other industries like agriculture and medicine in the same way. Artificial intelligence is going to be transformative even in those industries, and maybe even more so. So this is a broad-based technology supercycle that we're going to see. And I think that, as I said, I'm very much an optimist for the future.
Let's talk about what's happening outside of the United States and elsewhere around the world, because everyone says the world is becoming more multipolar. US exceptionalism, I think, clearly evident on this stage, still very much in play. But of course, we're also watching what's happening in China, India's rise, the surge that we're seeing in the Gulf. Everyone says it's a multipolar world, but when you look at these actual portfolios, most of the money is still invested in the United States. So the question is, are investors walking the walk when it comes to this question of being multipolar, or is multipolarity really just a buzzword here? So to boil it down, where's the best bet outside of the United States right now? Waleed, did you want to start?
Sure. So no, I think it's about how you look at risk. At the end of the day, for us, we see growth in so many different places. So yes, back to your first point, the U.S. is 42% of Mubadra's portfolio. Okay, fine, great risk reward. We think it's still going to keep going, and the truth of the matter is, it's probably not going to change very much materially over the next few years. But that being said, you look at Asia. Okay, look at what's happening in China. So China has had some difficulty over the last few years, but you're starting to see green shoots there. And so, China is our second largest trading partner. How do we not participate in their growth from an investment perspective? And so we've been consistently investing in China over the last 11 or 12 years, and we are looking at really interesting opportunities there that cut across both asset class and segment. Okay, same thing with India, Korea, Japan, and so you're all seeing kind of interesting opportunities. Each market's a little bit different, but there's no question that that's very interesting from where we sit. And then moving to non-U.S. Americas, I'll highlight Brazil. We've been in Brazil for almost 15 years now. And we've been able to create a franchise there where, again, you're able to source opportunities that are so interesting, where you are able to make an above-market return, given the risk that you're taking. And so I would say there is no shortage of opportunity. It just happens to be that sometimes you have to work a little harder to go find it when you're not talking about the United States, even though that's also happening in the United States as we speak too. But it doesn't mean that from a diversification perspective and from a growth perspective that you shouldn't be in these markets. Now, we're not perfectly diversified, okay? And so if I had to predict, I would say Asia's going to grow. But I think the point is that, again, for us, it's just really important to participate in growth where we see it, as long as the risk reward makes sense.
And right now, that's the US.
And right now, it's the U.S., but it's Asia too. You can't ignore Asia. Asia is growing, especially different parts of it.
And weigh in on this as well. Where would you say the best bet is outside of the United States right now? And when you zoom out and think about not the next quarter, but the next decade, what are some of the key themes that you'll be tapping into?
Well, so it's interesting. Last year in Davos, the theme of the year was American exceptionalism. By Liberation Day, that was over and everybody was running to Europe. But Europe still has structural issues from a regulatory perspective. And so flexibility is going to be important. Diversification is really remains important. And we find value, particularly in Asia, in equities. I think Japan is continuing to demonstrate that. Where do we go over the next decade, taking the really long view, is going to be parts of the world which are going to be able to harness the super cycle themes. And that's going to be those that can master and harness artificial intelligence, have power and availability, communications, education, demographics. Those are parts of the large macro backdrop that are relevant as well. And if we look at developed economies who have definitely a demographic headwind relative to emerging countries and their economies, that's also going to have a very significant impact. Education is also a key element. So when you're looking at these macro backdrop elements, key in on those that will be able to take advantage of and master the opportunity set that is coming.
Tony, your view?
I think broadly, the U.S. and our leadership in technology and innovation is going to drive returns globally over the course of the next 10 years. I think as you look, outside of the United States, the thing that comes to my mind, and the first country that comes to my mind is Japan. And I think it's really, structural reforms within that society that are going to be able to, continue to drive equity performance there. You've had 401k type equivalents. You've had an entire population that's missed out on equity performance, and after the crash in the 1980s, you've got their indices now at record highs. You've got a backdrop there where the government is encouraging structural reforms amongst the conglomerates to be able to unlock shareholder value. That sets up for a dynamic and a that I think they're going to continue to take advantage of, and that's going to drive outperformance into Japan. Structural reforms in Argentina, I think, have been able to propel progress there, and so I think it's idiosyncratic to to the country and how the country is going to embrace change and position itself to for growth.
Okay, so let's bring it all together with a final question for my panel, and this one's for everyone in the room. What would you say is one thing that investors aren't paying enough attention to right now that they probably should be? And can each of you name one risk that you think could possibly blindside investors in the next 12 months? Tony, I'm going to start with you.
So this is an interesting question. I talk a lot about gray swans, not black swans, because I think in terms of there's lots of risk and tail risk continues to increase. Again, we don't happen to currently have that kind of a negative view, i.e. recession in the U.S. and or around the globe in the same way. But that is something that we have to be thoughtful about is that two words that I tend to use that lend themselves to systemic risk. That is too much leverage and not enough liquidity. And right now, globally, we seem to have a pretty good situation with regard to liquidity availability and not too much leverage, notwithstanding the narrative around data centers and an increasing amount of leverage, but still way far away from it, from the level of systemic. But you often don't know where those come together and converge. And we've seen that in crises in the past. And right now, those might happen in small places, on the fringes, but not necessarily one that creates this sort of global economic meltdown like we saw in the financial crisis. So those are the 10, at the micro level, what I look for as signs. So canaries in coal mines, if you will.
Tony.
It's a hard question, and if I knew the answer, I would be up here. I think we're in a position, right now that change is inevitable, right? And it's about how do you adopt and really adapt to change. Is our government, going to be in a position to continue to, foster an environment for, innovation? Is that going to go, overseas? In terms of, one risk that we might be, overlooked right now, I think, certainly there's big companies that, you see, wild swings in NVIDIA's stock price after, Google comes out with their TPU-based chip and makes people rethink the value proposition of an NVIDIA. And what's, I had lost, $700-800 billion of market cap when you're a $4.5 trillion market cap company. I guess you can afford that, and you've had the run that they've had. But I think technology changes, really quickly. And if I was to bet on companies, I would certainly bet on Elon Musk's ecosystem, over ChatGPT. So I would bet on Microsoft. I'd bet on Apple. I'd bet on Google. They're so embedded inside of the ecosystem and have so much, technology advantage right now, and are, really, doing a great job of integrating AI into their existing ecosystem.
Okay, very interesting. Your Excellency, I'm going to give you the final say. The question was, one thing investors aren't paying enough attention to right now, and one risk you think that could blindside investors in the next 12 months.
So I'm going to start with the positive, which is something really interesting that I just read and have been tracking a little bit. And so if you look at one of the areas that we invest in is obviously healthcare, drug discovery, pharmaceuticals, that type of thing. And we started seeing that large Western pharmaceuticals are starting to buy up early stage drugs from a really interesting place. And you're seeing increased activity of them doing that from China. That never used to happen before. And so that's very interesting, first because it's never happened before, and second, it means that the quality of the science that's happening in China is really growing in leaps and bounds. And so prediction, you're going to see over the next 2 or 3 years increased pharmaceutical M&A coming out of China. where Western companies are buying compounds and drugs from, and these are cutting edge things that are coming out of China. So not to be ignored. I think that's number one. And then a risk that I worry about, not a short-term risk, but certainly a medium-term risk, is you worry about, and I think what's interesting is that everybody mentioned it without using these words. So when you say something like, I worry about the risk of kind of technology adoption going at different speeds, at the end of the day, at the heart of that, you're really talking about income inequality. And you're talking about kind of the increase in the haves and the have-nots. And so even though that's not an immediate thing that you know, I'm super worried about, I do worry about it over the medium term, because you are seeing that different economies and different governments are moving at different speeds. And if we don't keep an eye on that, you're going to get maybe a gray swan or a black swan that has the potential to really upend a lot of different things.
I really enjoyed our conversation. I hope you did as well. Thank you so much for sticking around to listen in. And ladies and gentlemen, please thank this exceptional panel. Thank you again.